Hi everyone, welcome back to Paisa, Bolta. Anand's in Bangalore, so he's asked me to fill in for a couple of shows. So you're going to see me here today and tomorrow. And since I'm here and I'm alone, I thought I'll talk about a couple of things you guys have been asking me on Instagram, LinkedIn, and other places. There's this whole thing about called technical trading, technical picks. What is this technical picks? And you see this all over the media, print media, and in digital media. Today's technical picks. So what are they and how does it come about it? And finally, I'll tell you, is there any value to this? Please do remember, I'm talking purely from an value investor point of view. I'm not a trader and I don't gamble, so keep that in mind as I go through this. I'm sure some of you do believe in trading and do believe in shorting and might see my opinions lopsided, as they say, but this is only my humble opinion. So I leave the information, I'm going to share this information with you, and I leave it up to you to make up your own mind of this being of value or not. Technical picks, the stock market refer to stock selections made primarily based on technical analysis. And technical analysis involves studying past market data, primary price and volume, to forecast the future price movements of a stock or a market overall. Analysts use various chart indicators and technical tools to identify patterns and trends that suggest stock's future price and direction, be it a bullish upward or a bearish downward. Technical picks are essentially stocks that, according to technical analysis, analysts are expected to perform well in the market based on their technical indicators and patterns. So, a lot of you are wondering, great, now you told us what technical picks are done by technical analysis using technical analysis. So what are these tools analysts use to analyze technically these stocks? The first category are called price charts. Or the first price chart which we talk about is called the line chart. What is a line chart? Line chart is plotting closing prices over a specific period, connecting each closing price in a simple line. It's useful to identify broader trends. So you take closing prices of a specific stock over a long period of time, and then you connect them in a dot, making a line on a graph, and then you extrapolate from that point, saying what you think is going to go, how it's going to go. That's a line chart, simplest as can be. The next one which comes from this is the next level of complication or complexity added on this. It's called the bar chart. Bar chart uses vertical bars to represent price movements on each bar, showing the open, high and low, and the close, or the OHLC, prices of a specific time. So if you look at a chart, a stock at a specific time, it tells you what was the opening price, what is the high, what is the low, and what is the closing. You can see it for a period of a day or a period of time, and you can put a chart just as a line chart. You can combine both of them, putting one on top of the other, seeing how the price movement's been for a period of time, and then see a chart on top of that with an added complexity of seeing how the opening, closing prices have been moving, with the high and lows been going through a week, a month, as long as you wish. And based on that, you can extrapolate further information. Further than this, they have something known as visual representation using candles. Everyone's seen this. It's a very famous animation which is done for stock market, and when anything stock related, market related is shown in media, this is the go-to visual representation of the stock market, which is nothing but a whole bunch of green and red bars, all vertical bars piled together going up and down a graph. So what do the candles display? It displays the opening, high, low, and closing, which is the OHLC prices, but it's color coded to show prices increasing and decreasing. And as expected, when prices are increasing, they're green. When prices are decreasing, they're red. So that's where you see all this red and green on the chart. Next, aside from charts, what else do the analysts use? What are the analysis tools are there? Then we have something known as price and volume oscillators. Okay, what is this? As complicated as it sounds, it's nothing really complicated. It's quite simple. It's a moving average convergence divergence. Indicates the relationship between two moving averages of a security price. So you take any two which you want to compare, and you see how it's correlating to each other, and you can see, is it diverging or is it converging? So based on that, you can see, is the security price correctly, if it's going to go up or go down. The further complexity on this is something known as the relative strength index, which is a RSI, which measures the speed and the changes of the price movement, typically on a scale from 0 to 100. So you're measuring the speed at which prices are changing and how much it's changing, the volume it's changing. So it's trying to see, like, please do remember, this is all looking back, this is all past information. Even if it's a chart which is today, it is on the price movement and the speed movement of what's happened so far. And based on that, they try and see what's going to happen. Then you have the stochastic oscillator compares the closing price to a range over a specific period of identified overbought, oversold conditions. So if a stock is overbought or oversold, then you see the closing prices and the ranges in that specific period and try to identify any pattern which you're seeing in that. If a stock is being oversold or overbought for any reason, why that reason is, and if that reason makes sense, is something you try to discern from this information. The next set of categories are called the moving averages. There's a simple moving average, which is the SMA, the average price over a specific number of period. So you take any number of period, you can break it down to when you're analyzing it, be it a week, a month, a year, and you can extrapolate information again from this. Again, this is all past information for that stock or that market or that index. It is not something in the future. It is so far what has happened, what you're looking at. Exponential moving average. Exponential moving average gives greater weight to the latest prices, reacting more significantly to price changes. That means it's more sensitive to the price changes currently what is happening than the past changes. So the past changes and everything, if you see an exponential graph, is always considered small. As you go further away from the origin, which is 0, 0, the exponential graph always goes up. So the sensitivity of this graph is such that it pays more attention to what is happening right now in the price of the stock than historically what's been happening, though the historical context is still there on the moving average chart. Now next, we've spoken about all this, which is all graphs and charts and bars and whatnot. Next, we get into something called trend indicators. Trend indicators are average directional index, identifies the strength of a trend. So it sees a trend which you've identified and you try to see the strength of the trend, be it a moving up or moving down. So this is where the MACD, which is talking about moving average convergent divergence, also used. This is it shows the trend, showcasing the relationship between any two moving averages, and try to see using that convergence, or is it diverting, meaning the price is going to go up in the future, or the price is going to go down, or is it going to hold this current price, is seen. You try to compare two moving averages and try to see if there's any relationship between it, and you try to see if there's a pattern which you can see. Then we have something known as the Bollinger Bands, or the volatility indicators, using moving averages of any standard deviation bands to identify volatility. Volatility is considered something which investors are wary of. If there's volatility in the market, most investors try and stay away. But for a trader or a guy who's shorting the market, volatility is his friend, because a trader will always look to volatility in the market. By using volatility in the market, they try and leverage and try to predict the volatility, the way it's moving, and try to make a profit out of it. So that is why they look at the volatility. Then you have the ATR, which is the average true range, which measures the market's volatility by decomposing the entire range of an asset price over a period. So you take a period of time which you want to analyze, which is up to you as an analyst to look at and see the volatility, measure the volatility and decompose the entire range of all the assets in that during that period and see what's happening and why it's happening. Then there's another famous one which all analysts on TVs and talking heads talk about, which is the support and resistance levels. The highlight of this is the price levels are where the market is historically shown to be strong and weak, meaning where there's strong buying or selling pressures. This is also again looking back. Historically, they've seen the price being at a certain level or being below a certain level. Then they say, okay, there seems to be resistance. We don't expect the market to go below this, or you don't expect the market to go above this, or there's support for this market at this price point. They say this based on historical levels and looking at historical averages. Remember this. Then you have the Fibonacci retracements. Using horizontal lines to highlight areas that support or resistance is shown using key Fibonacci levels before price continues to its original direction. This is a whole bunch of complexity to this. I, as a person who invests in markets, things the more complicated they become, I usually tend to shy away from it, because if something is not simply understood, I find it cannot be understood. So if it gets into this kind of a realm where you're looking at the Fibonacci levels over price continues over and looking at the original direction, it's getting rather complicated is what I feel. But then again, hey, if you're a mathematician and it's something you like doing number crunchings and looking at graphs, this might be right up your alley. And all this can be plugged into nowadays. You have AI. So these AI are called pattern recognition tools. They recognize patterns over a long period of time or short period of time as you feed in the data. And you can use AI right now to help you discern these patterns which you may have missed or you may have a bias towards, and give you insight which you're not seeing. So these are some of the broad tools used by analysts which I wanted to talk about. But there are other ones which are also there, which you may comment down below in your comments saying that which ones you're using as a trader or as a market observer. And other people who follow this channel may look into it and find it useful. The most important thing which I want to get into next is how great are these tools? Are they effective? Yes, Vinod, thanks for sharing all this knowledge, general knowledge that is. Now, how as an investor who's been watching your channel or Anand's channel, how can we use all this? Well, we don't do technical analysis. Me and Anand, we don't put any much water into it because we are long-term investors and value investors. And as a value investor, most of this technical analysis tools which I spoke about isn't really useful and effective for us because we don't look at upward, downward trends of a specific stock or a share before we buy. We don't look at the market's conditions before we decide to buy the Nifty index. When we decide to SIP, we look at what our goals are and then we try to place our bets where we get reliable, good returns over a long period of time. What is reliable, good returns? Anything over 10%, we consider it amazing. So if the market Nifty gives anything upward of 10% for a period of 10-15 years, we think that is fantastic returns because we expect to beat inflation, which is what we are trying to do. So do we use this? No. And all these tools are used mainly by people who like trading. And as I said on the onset of this video, I don't preach that you should do trading. I don't recommend you do trading unless you really know what you're doing. Trading, like I said, if you saw all this analysis tools, if you don't know what you're doing, all these tools and graphs and bars and chart could be much good as Egyptian and Greek to you and me. So when we get to this, there are people who are experienced analysts who have deep understanding of various technical tools and their applications. And these guys use this, you can say, effectively if you believe in it and not effectively if you've lost money with it. So their expertise allows them to combine these varied indicators and tool and confirm some kind of trading signals which they see. As far as I know, I don't know anybody, including my brother, who can predict the future or predict any market or any price movement with a 100% guarantee. So these things are as good as a weather report is. So would you use this? It's completely up to you. I don't see any water in this personally per se for myself. There are limitations to this because technical analysis mainly relies on historical data and past performance, which always is not a great predictor of the future. If we have seen anything in this world, history hardly teaches us anything. We tend to repeat history, true, yes. If we see some of our conflicts and some of our current global situations, it seems to have some kind of cyclical pattern which is going on a larger scale. But at the same time, each time it is different and you cannot reliably say that this time this is going to exactly happen because we seen this happen cyclically 3-4 times before. Yes, broader patterns are there, but smaller patterns to see and to profit out of that, it's next to impossible. And anyone who says that is lying because nobody can really predict where tomorrow Tata Steel will be. Different analysis use this interpretation and charts the same charts differently. That means I might look at a chart and say, I see Tata Steel going like this. You may see the same chart and feel Tata Steel goes differently. That's why Anand keeps saying that economics is a social science, it's not a pure science. Because you can see false signals and then these false signals can lead to potential losses. So what do I want you to take away from this video? The takeaway from this video is avoid trading. Is what I'm basically trying to say. And all this technical analysis and technical picks you see on the media and on print is just clickbait or make you buy the paper or buy the magazine. So you pick it up and you look at it and you say, okay, there is some value in this paper. No, there isn't. I would give far more weightage and value to editorials which are written and researched. I would advise you to read those more than spend time reading technical charts. Anyway, I hope you found today's Paisa Bolta video informative and entertaining. And I assure you Anand will be back in a day or two to talk about stock-specific information with you guys on this channel. Thanks for bearing with me today and I'll see you on the next one. Thank you.
मैं हैदराबाद में एक इवेंट करने वाला हूँ 28 अक्टूबर शनिवार को 4:30 से 5 बजे तक. जो उधर मुझे मिलना चाहे वो नीचे दिए हुए जीमेल आईडी में और व्हाट्सएप नंबर में कांटेक्ट कर सकते हैं. hyderabadmoneypage@gmail.com उसका ईमेल एड्रेस है. मैं आपको हैदराबाद में मिलाऊंगा.